Welcome back. It is 6:25 on your Monday morning. Taking a look at how things finished up on Wall Street last week. On Friday, Dow was down almost 160 points. NASDAQ went the opposite way, up a little bit, 18 and some change. As we know, interest rates have been on a wild ride the last few years. Many of us aren't exactly excited about where they sit right now. So what does that mean for investors and everybody out there? John Stewart is here with this week's Farmers Trust Financial Report. Good to see you, as always.
Good to be here, Steve.
So rates are still high right now, and they've been kind of inching upward this year. So what's causing this? What's behind all of this?
Well, inflation's obviously a big reason why rates have risen, and the recent rise in oil prices again here is continuing to put upward pressure on inflation expectations. But the big thing that has really driven this most recent leg higher is a pretty rapid deterioration in the federal government's fiscal outlook. The federal budget deficit is projected to be double what it was last year. And we've added more than $1 trillion to the national debt just in the last 3 months alone. So, investors are really starting to require a higher interest rate to buy that Treasury debt as compensation for the risk they're taking.
I mean, we've talked a lot over the last couple of years about the Fed raising interest rates, trying to thread the needle when it comes to inflation. How much does this play into that, too?
It's going to make things very, very complicated for them because obviously rising interest rates tends to put some downward pressure on economic growth and causes some instability in the financial markets, as we've seen here over the last couple of months. And so now the Fed is going to have to choose between, do they try to loosen monetary policy a little bit and ease things back a little bit in order to try to protect the economy, potentially risking another surge in higher inflation, or do they say, all right, we're going to fight the inflation battle, and if that's going to cause a recession or some further economic deterioration, so be it.
I mean, I mentioned thread the needle, too. I mean, this is now, it feels like you're really walking a tightrope a little bit. Is it much more challenging now to find that balance and avoid a recession with all this other stuff going on?
Absolutely. Yeah, I think that, we thought possibly here earlier this year, as the stock market started to recover and as inflation started to moderate, that maybe the Fed was successful in their effort to thread that needle. But now we're starting to see, well, maybe it wasn't quite, all clear as we thought it was, and maybe this is going to be a little more challenging for them to thread that needle.
So what does this mean for investors right now? Should we be changing our strategy at all because of this?
Well, I think you're going to need to be a little bit more careful. Heavily indebted companies that need to raise capital or have high capital requirements and high costs that are built into their businesses are going to be a little bit more under pressure. Businesses that don't have a lot of debt, don't need to borrow money, and don't have as many input costs into the manufacturing process may be a little bit more, able to weather the storm. So, it's going to be a question of just not necessarily buying the entire market, but trying to pick spots and maybe be a little bit more defensive and understand, what the risks are of the individual companies you're looking at.
So it sounds like, though, there could still be opportunities, though, for investors. I mean, we always hear, buy low, sell high type of thing. Yep. Could there be opportunities out there?
Oh, absolutely. I wouldn't, panic and run for the hills. I think that these types of environments are the ones that create the opportunities, because whenever you see some market volatility, it does give you an opportunity to go out and shop for companies, high quality companies that are on sale. So I certainly think some of those bargains are going to be out there here over the coming months, and it'll be time to go shopping and look for high quality companies to add to your portfolio.
What's the biggest thing you're watching now when it comes to the interest rates and how things are going to go as we approach this the last quarter of the year?
Well, really, I keep an eye on what earnings estimate expectations are for the next couple quarters. And so far, we've actually seen earnings estimates hold up pretty well for the fourth quarter and into the first part of next year. So as long as that continues and we don't see those earnings expectations fall off a cliff, the stock market should be able to hang in there pretty well. Now, if that takes a turn for the worse, we might need to be even a little bit more defensive than we already have been.
Now we have the warning bell starting to go off. All right, John, thank you so much. If you have any questions for the fine folks at Farmers Trust Company, let's take a look at the number on your screen right there. And if you have any segment ideas you'd like to see one of their experts talk about, we do them every Monday at this time. Send us an email, farmers@wfmj.com. Send things back over to meteorologist Andrew DiPaolo. Now take a look at the forecast before that falls off a cliff, too.
Yeah.